Is the equity market in a bull or bear market cycle? Our guest, Martin Pring of Pring Capital, shares with us his latest view based on a very important technical signal that he's watching right now. We have a chart of the MSCI World. What's your key thoughts here on the World Index?
Well, this is a monthly chart. It goes back to 1969. And it shows the World Stock Index in the upper panel. And in the lower panel, we've got my global diffusion indicator. And what this is an oscillator that calculates how many markets are above their 24-month moving average. That's what the 24 in the brackets means. And as we move into the cycle, so the indicator keeps picking up as more and more markets join the leading markets above their 24-month moving average, and we get an overstretch or overbought reading. So when that reading begins to turn down from being overstretched, that's typically when we get an indication that the global market is in the process of peaking. And so the red vertical lines give you those periods when the oscillator starts to cross below that overbought line, that dashed black overbought line at +8.
And I see now on your slide, just looking at the most recent label there, it suggests another sell signal.
Yes, well, the vertical lines represent the sell signals. The solid ones represent valid sell signals. In other words, when they trigger a bear market, and the two dashed ones indicate when the indicator failed, in terms of signaling that the market was going to come down. So right now we have another sell signal. That doesn't necessarily mean that the market's going to crash, because one of the things that, well, I wouldn't say crash, that's rather a strong word. The market is going to come down in a bear fashion. But right now the MSCI World Index is above its 12-month moving average. It's at the end of April it was $71.99, and the moving average is around 69 and change. So it wouldn't have much further to fall, and if it did, that would kind of confirm what's going on with this global diffusion indicator.
And would that suggest a price magnitude of the market fall, Martin?
No, there's no way in which we can forecast how bad or how sharply a market's going to sell off, or what the characteristic of the decline might be. Sometimes it's a pretty devastating thing like we saw in 2008. And sometimes it's a relatively mild affair, as we saw in 2014 to 2016. Remember, that was when we had one of those slowdowns. So there's no way of going into these things of knowing how bad it's going to be, or indeed if it's not going to be a failed signal like it was in 1994 and 1997. But one of the things that we do know, that when the oscillator peaks and starts to drop, is even if it doesn't affect the world index, it does indicate that fewer and fewer markets are above their 24-month moving average. So it indicates a more selective environment.
And so it maybe serves as a breadth indicator of some sort with the world markets.
That's correct, yes.
Okay, and now looking at the next slide, I believe it's the S&P composite. What does it say for one of the largest markets out there in terms of psychological influence?
Well, at the end of April, this indicator was in a bullish mode. So, as you correctly point out, we have the S&P composite in the top panel, and underneath is my RSI diffusion model. And what that does is a similar thing to we saw in the previous chart, except we're looking at the RSI oscillator and calculating a basket of S&P industry groups that have a positive trend as defined by this RSI. That number would be pretty jagged, so what I've done is I've thrown a moving average through it to smooth it out. But the point is that when you get most of the groups in a bearish mode in terms of the RSI, and then it starts to turn up, that's when we get one of these green arrows. And the solid arrows indicate solid advances following this reversal, and the dashed arrows indicate failed or very weak rallies that have taken place after it's turned. So we're looking at, when we're talking about it turning, we're talking about turning from below that lower green line just there.
And Martin, how significant is it that blue line, the part of the RSI model diffusion, seems to be the lowest level in prior troughs? So it seems to be a multi-year record of some sort in terms of the extremity of the downside momentum?
Yeah, it's pretty big, but it doesn't really have that much influence. To give you an example, it depends on whether it's being triggered during the course of a primary bull market or a primary bear market. So once again, if you recall, the solid lines represent valid signals, and you notice those basically occur during the white areas of the chart, and the dashed arrows typically occur in the pink shaded areas. Well, the pink shaded areas indicate bear markets, 3 bear markets, or 1 bear market, and 2 and 3 represent mini bear markets. So if this signal is occurring, let's suppose, for example, that we're in a primary bull market now. That signal will probably indicate that the S&P is going to go on to significant new highs. If, however, we're in a bear market at this point, and we don't know that we're in a bear market, we could be in a situation like we were in 2007. At that, you can see there's on the left pink shaded area with the number 1 by it. We saw a rally between August and October of 2007. The market made a marginal new high. Our indicator bottomed from around the same level it is today, but it resulted in a 4th rally. So that's the key. Are we in a bull market or a bear market? And right now, all the indicators, the trend indicators, are still indicating a bull market. So we have to assume that this is a bull market signal.
And I was just going to say, Martin, I know your approach heavily looks at, within a top-down approach, the sectors and as well. And just out of interest, is there any sign of leadership for a potential rally higher?
Well, I think we still have the old leadership. We have the technology at this point that's still acting well on a relative strength basis. So that has quite a lot of weighting in the index. I'm not so sure about the financials. They have a fairly high weighting too, and they haven't been acting so well in the last few weeks. But and the other thing is that if we are in that period that I mentioned on the previous chart, where we're between the bond market having peaked out and the stock market about to peak out, that's usually good for commodities. So presumably we would see energy stocks do well as well.
Thank you very much, Martin, for joining us today on our SAMT interview.
Thank you, Ron.
And that's it from myself, Ron William, Vice Chair and Head of the Geneva chapter of SAMT, in partnership with Dukascopy. We look forward to seeing you the next time.